So we're very fortunate to have with us this morning or afternoon, depending on where you are, Carol Alexander, who is an expert in several areas of finance, including crypto asset and derivatives markets, financial risk analysis, high frequency data analysis, blockchains, pricing and hedging financial instruments, and investment strategy. She's had a dual career in both industry and as an academic, and is currently professor of finance at the University of Sussex and visiting professor at Peking University Business School. She's been editor of the Journal of Banking and Finance since 2013. Throughout her corporate and academic careers, Carol has designed and implemented mathematical models for pricing, trading, hedging, and risk assessment for a wide range of asset management, stock exchange, and banking clients, including investment banks such as Crédit Agricole, Flemings and Hill Samuel, asset managers such as the Shell Pension Fund, Tindico Asset Management, Pioneer Capital Management, Equitable House Investments, and Alpha Strategies, and the largest global exchanges such as the New York Stock Exchange and Intercontinental Exchange and the FTX US Exchange. Carol is the author of the best-selling textbook Market Models and of the 4-volume textbook series Market Risk Analysis. Her latest textbook is Corruption and Fraud in Financial Markets, edited with Douglas Cumming. Carol has held corporate roles as a director and head of market risk modeling for Nikko Securities, as a director of Algorithmics Incorporated, and as a bond analyst for Phillips & Drew, City of London. She has worked as a consulting expert witness and served as chair of the board of Premia, the Professional Risk Managers International Association. Oh, and also she's a very active and generous member of the steering committee of the CFI and has done many, many things for us over the years. So thank you for that, Carol. And whenever you're ready, you should be able to share your.
Hello, hi. So can you hear me? Hopefully you can, and I can share my screen.
Can hear you, don't see the screen yet.
Yeah, all right, it's coming. There we are. Apologies for being late, and I hope do we have a break after this? There's a small break, so if I go a little bit over, it's not too bad, yeah? Hello?
Yes, but yeah. Am I the only one who doesn't see the slides?
Oh, okay.
Shane, is Carol co-host to be able to?
Yeah. Really busy. I'm going away next week and therefore rushing to get things finished, and then I had the wrong slot in my diary. So here we are. That should be doing it.
Yes, okay. Perfect. Thank you.
Yes, I see it now too.
Yeah, apologies. Okay, so I'm going to be talking about a paper with Jun Deng in UIBE in Beijing, and Bin Zhu, who's at the University of Connecticut. And it's a paper called Hedging with Bitcoin Futures, the Effect of Automatic Liquidation and Leverage Selection. I'll send you the slides, David, afterwards, and all these blue things are linked. So if you want to find out more about me, just click that one. You'll see my website with links to various other papers. This is the paper if you want to take a look at it. It's on archive. It's currently with a journal, and when we get it back, we'll be doing some more work on it. So it's really good to be able to present it here for your comments. Okay, so the idea here is that we model hedging Bitcoin spot with Bitcoin perpetual or calendar futures. The theory would apply to either, but in practice for our empirical work, we're just going to be using these things called perpetual contracts, and I'll explain why in a minute. And it's a very fragmented market. Obviously, Bitcoin spot, is traded on lots of different platforms, but also an increasing number of centralized crypto derivatives exchanges. I won't be talking about trading on decentralized exchanges, which are on the blockchain. These centralized exchanges are like sort of off-chain motorways, like the shopping malls for NFTs like OpenSea, but also these exchanges. A lot of them don't accept fiat, so you would be able to track on and off onboarding and offboarding with the hot wallet of the exchange. But if you upload fiat and take off fiat, then there's no record anywhere of what you're doing on these exchanges. So there's a lot of most of them are not regulated apart from the CME, and that doesn't trade 24/7 like Bitcoin spot does, so we're not looking at that. And the other centralized exchanges because of this anonymity and lack of regulation, there's a lot of speculation. This takes you to a blog that shows a lot of spoofing with very, very high frequency trading bots. So we analyzed some data here, just proving that on one of the exchanges, and it's all out that there's arbitrage spoofing as well. It gets very, very interesting, but also quite complex. Okay, so I'm going to talk about who hedges Bitcoin, of course, because it has to be a relevant problem for the industry, and how they would do it, what products are available. And then I'm going to give an overview of the type of trading on centralized crypto derivatives exchanges. They're very different to standard TradFi exchanges. They operate as brokers, custodians, but also their own clearinghouse. So this is a bit of an operational risk to people trading on these exchanges, which we incorporate into the hedging problem in a formal way. Now we're going to compare the different venues that are available, not just from the products, but also from the point of view of the degree of speculation that we find, and standard metrics, which is just like trading volume related, are not really adequate in the new environment with the sort of new microstructure that we have on centralized exchanges. So we'll introduce 3 new metrics for speculation. Well, 2 new metrics and 1 that combines the 2. And then talk about the problem in mathematical terms and look at some empirical results. So to begin with, who hedges Bitcoin and how? Well, first of all, institutional investors are moving into this space, a pretty steady stream now, not just a trickle. And Bitcoin can be very, very well hedged. And all the other currencies seem to move more or less in line with Bitcoin. But then, of course, there are deviations in different sectors. DeFi is doing very well, NFTs doing very well, etc., etc. So it's become sort of normal to use Bitcoin as the numeraire, and part of the risk that if you do a risk metrics, I'm developing one at the moment where you can choose Bitcoin as a numeraire instead of the dollar. So if you have that as a numeraire in your portfolio and you can completely hedge Bitcoin risk, then you get a much better view of what's available in crypto. But most of the current people hedging Bitcoin are companies whose profits are tied to Bitcoin and other crypto, but they have expenditures in the local fiat currency. And there's a long list of them. Obviously, the metaverse developers, you must have heard a lot about the land sales recently in the metaverse, blockchain miners, then, of course, the exchanges I'll be focusing on, and the market makers in those exchanges. And then there are other crypto brokers and custodians. All have expenditures in a local currency, but their income's tied to Bitcoin. And the instruments are not just the sort of standard products available. For example, on the CME, those products we're not going to look at because the trading time is not 24/7, but there's standard futures that are a little bit like commodity futures. Bitcoin's the underlying. They're quoted, margined, and settled in dollars. And they have standard calendar expires. CME just introduced a micro Bitcoin and Ether futures and options. So they're the standard ones. But the direct ones are very similar. That we call them direct futures to differentiate them from the inverse products that most of the exchanges now offer both. And here, Bitcoin is the underlying, quoted, margin, and settled not in dollar, but in a stable coin, usually something like Tether or USDC, or the Binance stable coin. So, for example, on Bybit, you can get a very small direct Tether future on Bitcoin with a notional value of 1 Bitcoin. And then the inverse futures, these are popular because you can trade against the dollar, but you don't have to onboard or offboard fiat. You can just do it all in crypto. So here the USD is the underlying, And although they're quoted, and it looks the same as they're quoted in USD per Bitcoin, just like standard futures or direct futures, but they're margined and settled in Bitcoin. So, for example, the notional value would be in dollars, $100, but you're margining and settling in Bitcoin. So we call these inverse futures. And the perpetual contracts are unique to crypto derivatives exchanges. They have no maturity. They go on forever. That's why they're called perpetual. And the way that the spot price is tied to the perpetual price is through regular funding payments that are made at midnight, 8 and 16 at UTC. So every 8 hours. Some of them have funding payments every 4 hours, but mainly every 8 hours. And it depends on whether the perpetual price is above or below the spot price. When it's above, there's a positive premium, and when it's below, there's a negative premium. And the funding rate is the sum of a very small, like 1 basis point interest rate plus that premium. So generally, when the perpetual price is above the spot price, you'll definitely have a positive funding rate. And that means that the long counterparty pays the short counterparty. So if the perpetual price is above the spot, the long pays the short, and if it's below, usually the short pays the long, but there's that tiny interest rate. So this link here will take you to the calculation of funding payments on Binance Academy, which has some pretty good documentation here, and you'll see these funding rate calculations depend on impact prices. So they're also looking at the sort of liquidity as well along the curve. So let's now look at the trading on centralized crypto derivatives exchanges. Actually, I did have a graph there for the funding payments, but I think that comes a bit later. Where is the funding? There we are. That's the funding rate. Let me just show it to you now. And you can download the data on that link. So you can see this is just for one product. That's the direct tether perpetual for Bitcoin traded on Binance. And you can see that the funding rate went up to 30 basis point very briefly. This is around the Black Thursday, March 2020. And it's often positive, but more recently there's been a bit of a bear market the last couple of months, and there have been negative funding payments because the perpetual price has been much lower than the spot price, and so have the other calendar futures. So yes, let's have an overview of crypto derivatives exchanges and how they trade. This is a month by month aggregated volume. So you can see monthly volume hitting 5 trillion over all the exchanges in May 2021 here. That was a bit of an anomaly because something happened on Binance on the 19th of May, which hit quite a few headlines. It's a class action now because a lot of people trading there were unable to adjust their positions and got wiped out. And I'll be going through in a minute the mechanisms that these exchanges use for their clearing. There's no margin call. They just, it's your responsibility to monitor your position, and you could get completely wiped out of that position, or you could go completely bankrupt over your entire account, whatever positions you have. But you can see Binance, at the time I started to work on this with Bin and Jun, it was around the beginning of 2021 or so. And Binance was clearly growing at that point. But so, of course, we included it in the analysis. But we also looked at BitMEX, which had a very strong, it used to be the most commonly traded perpetual product. But BitMEX went through a bit of regulatory risk, shall we say. They got investigated for KYC practices by CFTC, and they complied, and then they lost the ones that haven't complied with know your customer and so forth. It's very easy to get an account on the other exchanges without even showing your driving license or anything like that. Not Coinbase, of course. Anyway, these are the derivatives exchanges, and you can see that of the volumes at the moment, there's about 3 trillion traded. More than 50% is on Binance, and of that, at least 50% of the trading on Binance is on the one product, the Binance Tether Perpetual. Although more recently, the Ether Tether Perpetual has also got a lot of trading. So as I said more recently, just April and May, Binance, this is daily, 50 billion per day is traded on Binance. There's about 20 billion a day that's traded on that Tether Perpetual. We're going to be looking at Deribit because it's quite a different type of, it's still self-regulated, so to speak, but domiciled out in the Bahamas, or I think it's Panama there, whatever. They all move around to these unregulated venues. Deribit is now a very, very small part, but it's an interesting exchange because it's the major options exchange. And this link will take you to some interesting data from CoinAnalyze. I might look at that a little bit later when we look at liquidation data. I've shown you that. Now, as I said, Deribit is tiny. I mean, you can see the daily trading volume is, peaks at 2 billion, but generally speaking, it's around 500 million. Tiny compared with the 50 billion that's traded on Binance. But this graph is from a paper that I've just finished with a PhD student called Arben Imari. You can find it on SSRN. It's not actually been released yet, but I thought I would use that because it's the most up-to-date view we've got on how trading has been evolving recently. So we can see there's a couple of peaks in trading. This would be across the board, not just in Deribit, but all the calendar futures together constitute maybe 1/10 of the volume of just one perpetual. The Deribit Perpetual is one of these inverse products, and it's clearly dominating the trading. The spreads are tiny. They're the sort of minimum tick size, so it's about half a basis point or something like that. They're a bit more on the futures, but it's so dynamic delta hedging is clearly very low cost using this product, and that would be the obvious one. Okay. Now, clearing activities. Talked about liquidation. So there is a protocol that you'll find on any of these exchanges' websites, which governs the way that margins are managed. So instead of having a set margin amount, users can select the leverage they want, and it can be up to 100 times for the direct products or 125 for the inverse products. And although there's been some news recently that maybe it's going to be limited to 20 times leverage, there is also evidence that many users can get 100 times leverage if they want. So the initial margin, of course, is the reciprocal of the leverage. So if you've got 20 times leverage, you've got a 5% initial margin rate. And so you have a collateral account that covers all your positions. So that the balance is your initial collateral used to open the account. And then if you've exited any previous positions, you may have made a profit or loss, and that gets added to the collateral, unless you change it yourself. Of course, you can always add collateral and take it away. And then you have the unrealized profit and loss from all your positions, which is based on something called the mark price. And the mark price is a sort of smoothed price aimed to prevent people getting wiped out through this liquidation protocol if there's a flash crash or something like that. And I won't go on that link because I started late already, so you can have a look at the fair price marking mechanism on that. So the maintenance margin will depend on the position size and the platform you use. Again, using Binance and the Bitcoin Tether Perpetual as the example. For a small position, your maintenance margin is only about 0.4%. So the maintenance margin would be exhausted with just a 0.4% fall for a long position. And 2.5 for a larger position, but still it's tiny compared with the CME maintenance margins that are, they're risk-based, so they're like 30–35%. Anyway, so with that level of the maintenance margin, whenever your collateral falls below the maintenance margin on any position, then that position is automatically liquidated. And if we look at as I said, no margin call, if we look at the history of automatic liquidations, here I'm using the inverse perpetual products. This is taken from the paper with Bin and Jun. We see that week by week, for example, here in May, there was about these 5 exchanges combined, BitMEX, Bybit, Deribit, OKEX, tiny little bit reported on Binance, strangely, was about $500 million on the short side and about 1.75 billion on the long side. Again, very, very low figures from Binance. But the thing is that here, where you can see there's quite a few liquidations on Binance, they changed the reporting very soon afterwards. On the 27th of April, they decided they would only report 1 liquidation trade per second. Whereas on this date, there were about 140 liquidation trades per second for a few hours on this day. So it's a gross underreporting of the liquidation volumes on Binance here. Anyway, notwithstanding that, and the fact that Binance is the biggest exchange and our data just go awry after the first 4 months of 2021, the reported liquidations is about 80 billion of positions were liquidated, about 200 million per day. Most of these are, not the professional trading bots. They would be the retail traders who are bringing the class action. Now, another date, 12th of March 2020, it's not shown here, but the BitMEX Perpetual, which was the big one at that time, exceeded 800 million on that day. If you want to get more information about liquidations, you can find them on Coin Analyze, so you can see them here. But as I said, the Binance ones are underreported because they only report 1 trade per second instead of hundreds. Okay. When we look at the Bybit data, which is not underreported, again on USD inverse perpetuals in this case, we can calculate a sort of historical frequency that gives us an idea of the sort of probability of being liquidated if you don't do anything to your collateral. So let's have a look at this. Using data from 1st of July 2020 to the 31st of May 2021. Our data set stopped at the end of May 2021, partly because we don't get the liquidation data that's accurate enough from that time or before then. So we suppose a trader opens 1 long or short, short or long position over a trading horizon of 8 hours or 1 day, and it doesn't do anything, just opens it and leaves it for a day or 5 days or 15 days or 30 days. And then chooses a leverage of say 5, 20, 50 or 100 times. And then when the marked loss, the marked price, it makes a loss that exceeds the collateral, and the collateral is determined by the leverage you choose, then there would be a liquidation. So for example, if you had 100 times leverage and the maintenance margin would then be say, the initial margin 1%, maintenance margin usually about half that on Bybit, so that's 0.5% of the nominal. So whenever a mark loss exceeded 0.5%, because that's all you've got in your maintenance margin, there would be a liquidation. So it's terribly risky to take these very high leverage position unless you've got collateral in your general account that can cover it. Um, okay, so counting up using historical frequency with which mark loss exceeded the maintenance margin, you find that within 8 hours, if you've got 100 times leverage on a short, you're still 50% likely to get liquidated within 8 hours. Around the same for long, a little bit less. Within a day or 5 days, with almost 90% sure that you're going to get liquidated with 100 times leverage. So we didn't actually look at any longer than a 5-day hedging horizon because the probability of liquidation would just be far too high to get any sensible results. So we just looked at these hedging horizons in our empirical analysis. Right, so speculation metrics. The turnover index, which is the standard measure, doesn't capture the ability of users to choose their own leverage, because it's not just the liquidation that actually we haven't taken account of something else that can happen, which is called automatic deleveraging. So this leverage is a really important factor, even if you've got plenty of collateral and you are not liquidated. You may be the counterparty of a liquidated trade, so you may be short when lots and lots of long positions are liquidated. And in that case, if you've got a very high leverage, there's a risk that you will be ADL'd, automatically deleveraged. In other words, you think you've got a position that's making loads of profits because you've got 100 times leverage or 50 times leverage, and the next time you look, you've only got 5 times leverage, so your profits are 10 times less than you thought they would be. And so what happens when a counterparty is liquidated is that their position is immediately passed to something called the liquidation engine, which is a high-frequency trading bot which is programmed to execute immediate or cancel orders as soon as it can at the liquidation price. The liquidation price is a sort of price that tells the user in simple terms that the collateral is exhausted and they need to, if the mark price falls to the collateral, to the if the mark price falls to the liquidation price, then they have to add more collateral, otherwise they're going to be liquidated. And below the liquidation price, they have a bankruptcy price. And in between the liquidation and the bankruptcy price, this liquidation engine comes in and tries to clear that position that it's taken over because it's been liquidated, in order not to make that user completely bankrupt. And hopefully they will fill as much as they can at the liquidation price. If not, they'll put in another immediate or cancel order, and hopefully they clear it before the bankruptcy price. And so although all of the orders of that liquidated user would be cancelled, they wouldn't have any open orders, the other positions that are open would remain in place. But if not, then it gets to the bankruptcy price and then all the positions are bankrupt. So it's sort of contagion on the exchange, because lots of counterparties could then find themselves automatically deleveraged if there isn't another way of clearing those trades below the bankruptcy price. And that is the insurance fund that then takes over, not with a very, very high frequency trading bot, hopefully, but gradually and orderly will take those positions, can hold them for as long as it wants, but keeps your counterparty there without having to do the ADLs. The problem comes when the insurance fund is maxed out because there are limits. And if there's lots and lots of bankruptcy going to the insurance fund, then unfortunately, there'll have to be automatic deleveraging. So it's a very risky business, and we need to take account of leverage. That's the most important aspect, and it's not taken account of in the turnover index. So the new speculation metrics is based on the volume of liquidations, as well as another metric called implied leverage. And then we combine those two together to get a new metric that we call the trading aggressiveness. And that gives the most balance. It's not just liquidations, it's also leverage together. We can compare the speculation of different centralized exchanges. So if we just look at the turnover index, which is just trading volume, it's the trading volume over open interest, then we find that Binance comes out as the most speculative, even though it isn't even reporting all the, in terms of trading volume, this is not liquidation, so yes. OKEX also has a lot of trading volume and a very circular pattern. We find that there's a lot of speculative trading activity on OKEX during the times when the Chinese market is open. And the least speculative, according to this index, is the Deribit exchange. Deribit, as I said, is the main options exchange. It has much lower volumes, 0.2 billion on average, compared with 1.3 daily volume on Binance during this period. We also report the median figures here. For the rest of the metrics, we're just going to have a look at the mean figures, nothing else. Then we've got this liquidation index, which is the proportion of liquidation volume to trading volume. Here we find that Binance becomes one of the least speculative. It's almost the same as Deribit, as I said, because it's just not reporting their liquidation volume properly. BitMEX and Bybit look very highly speculative, in particular Bybit. On the direct tether perpetuals, they're the maximum speculation for the long and the short, and overall the total is maximum. Oh no, sorry, I've got it wrong here. It's also here, 1.38. Change that typo slide, whatever it is. 1.38. Okay. Now, implied leverage. Let's just go through the argument for a long position on a direct futures. So suppose we use a leverage lambda, L for long, D for direct. Open it at time t when the perpetual price, the opening price, is F0. So your initial margin is F0 over lambda LD. That would be measured in USDT because F is measured in USDT. Assume no addition of collateral or taken in or out. And then assume the maintenance margin is half the initial margin rate. So the maintenance margin rate will be 1 over 2 lambda LD. And then the collateral in your margin account will be the maintenance margin itself, not the rate. So put an F here on top, that makes it into USDT. And then the difference between the two is the collateral that you've got left in your margin account. This is what you put in, and this is your limit that you mustn't go below. So the maximum loss on a long position in the interval, T would be your hedging horizon, or trading horizon. And so the maximum loss on a long will be F0 minus FL. Other way around for a short, of course, that's the maximum loss, where this is the low price, FL for low. And liquidation will happen if your maximum loss exceeds the collateral. So the collateral, just here I've taken the 1 over lambda out, but it's the same expression here. And so we've got F0 minus FL exceeds that. Put equality and solve for lambda L. That will give us the minimum leverage to prevent order liquidation, which we call the implied leverage. So there's a formula there, and we can also find equivalent formulae for the inverse product and for the short positions as well. And when we look at implied leverage, well, then we find that it's pretty high on all the exchanges except for Deribit. Again, as I said, Deribit is really the options exchange. The trading on the USD inverse perpetual there is a lot of proper hedging, delta hedging behavior. So that's why I think there's much lower leverage on Deribit. So we also have in an appendix for the paper, which is quite long with lots of preliminary results, time series of these implied leverages for different hedging horizons, like every 8 hours we've looked at them, and they can easily reach 30% or more. So there's quite a lot of leverage being taken. This is just an average over all traders. And finally, this aggressiveness index combines the liquidation volumes, long and short, with the implied leverage into one measure here. And we can also just take the first part, the first term, which is the long liquidation volume term over the total volume, and then the short liquidation volume over total volume, to get the aggressiveness for long and the aggressiveness for short and overall. And again, Bybit reported the most aggressive and Deribit the least aggressive. Okay, now let's get on to the mathematical problem, which was posed and solved by Bin and Jun using the generalized extreme value theory. The proofs are all in the appendix to the paper. Here I'm just going to set up the problem in simple possible terms, just for the profit and loss formulation and for the direct perpetual. So this FT would be in USDT. The paper theory has the returns formulation, and it also looks at direct and inverse perpetuals. So we assume the hedger is long 1 Bitcoin with the USD spot price ST. In our empirical work, we've looked at the Coinbase spot price, we've looked at the Bitstamp spot price, and a few others, but we're just going to present the empirical results for the Coinbase spot price. So he shorts theta units of the perpetual to hedge the spot price volatility over some hedge horizon, and when it comes to possibly being liquidated, we suppose the platform monitors the margin at like 1 minute intervals. Delta T is 1 minute until, or it could be 5 minutes or whatever, it's just a general interval until our hedge horizon, which is N periods from now. And as I said before, our hedge horizons are only going to go up to 5 days, because 15 days and longer, the liquidation probability was so high. So in these terms, our standard hedging problem is just to choose the hedge ratio to minimize the variance of the hedge portfolio, delta H, and the hedge portfolio P&L will be the P&L on the long spot minus the P&L here, because this is the short position, so there's a minus. And we're going to assume that the USDT is equal to USD, so everything is measured in USD or USDT. Adding the margin constraint. Well, we represent it by a positive number, M upper bar, and we regard this as an upper constraint on the hedger's ability to avoid liquidation. So that's the collateral and the margin account in excess of the M0, the minimum maintenance margin. And so we have these two quantities here, M bar and M0, which will be parameters of our solution. And then we use the extreme price change operators, the maximum drawdown or the maximum upbeat, if you like. So in this case, we're looking at a long position here. So this is going to be the maximum drawdown. This would be, if this is positive, and if this change is positive, it means that this price is above that, and similarly for this. So during our hedge horizon up to N, if there is any maximum loss that exceeds our collateral, then we will be wiped out. So when this thing is positive, the short position will make a loss. So the total loss will be theta times this maximum drawdown. And if that exceeds the M bar, the margin that we have, the collateral in the margin account, then there'll be an auto liquidation. And we're going to call this thing P M bar theta, because those are the two parameters of the probability. Obviously, when M bar gets smaller, this probability will decrease. And as theta gets larger, the probability will increase. In other words, if you have more reserves, that decreases the probability of auto liquidation. Or if you have a smaller hedge ratio, less risk-taking activities, in other words, less of a position on the perpetual, your probability of liquidation will reduce. Now we need to add this P to our original standard minimum variance objective. So that's the original objective, and adding P, obviously it's not in the same units of measurement, so we need to put it in the same units of measurement, so we multiply it by sigma squared delta S. And then we introduce a new parameter, which is default aversion or loss aversion. So the higher is lambda, the greater the aversion to the probability of being automatically liquidated. And then we choose theta to minimize this whole new objective. And as I said, Binance solved this using the extreme value theorem to obtain an analytic expression for this. The optimal hedging strategy, how much you should put into the futures, is a root of this equation, which is, well, a cubic equation actually. We're writing it like this is fine, I suppose. And so in the limit, this AX will tend to 0 as the probability of liquidation tends to 0, as this thing goes to, as M bar goes to 0. So you're left with X equals B. In other words, it's a root of X equals B. And so this B is the standard minimum variance hedge ratio. And then just for short, we put nu equals the square of the relative volatility here. And then we've got this expression here, which depends on X, as well as the parameters of the solution. And so the solution turns out to be this, as I said, based on the extreme value theorem. The parameters of the solution are alpha, as well as, of course, the covariance and the variance of the spot and hedging instruments. There are these parameters, gamma, which is our default aversion, and alpha, beta, and tau, which are the scale, location, and tail index parameters in the right tail of our maximum drawdown. So the important parameter actually turns out to be the right tail index. Here's an example of empirical estimation of that right tail index and the results that we get for direct perpetuals in the Coinbase spot, and for inverse perpetuals you can see that they move pretty much in line with each other, apart from Bybit, which is much lower volumes now. The Bybit exchange from that very first graph I show you is really not doing very well, and the Deribit is also out of line here, but then that's quite a different sort of exchange. So in order to do that, say we've got 30-minute monitoring, actually we do it 1 minute, but so it's 30 minutes, and then for a day we'd have, for each 30-minute interval, we would look at, we'd have 24 observations, and then we'd take the extreme value over the day. So we'd have one extreme value for that day, one for this day, and so on and so on, and we'd end up with 210 daily extreme values from which we can estimate the parameters of the GEV. And then we hold these parameters constant for our hedge horizon, say it's over 5 days, and then we would roll forward the next 5 days if we're doing a 5-day horizon and repeat. Or if it's just a 1-day horizon, then we would roll forward 1 day and repeat. Or if it's 8 hours, etc., etc. So we can see these tail indices move together. They're about 0.5 down to about 0.3. Okay, so the first graphical results here are on theta star, the size of the optimal hedge position, and we do it for 1 day, for 5 days. On the left, it's for the inverse perpetuals, and on the right, it's for the direct perpetuals. Again, we see Deribit spin out of line, and so is Bybit, but the others very, very similar results for the optimal hedge position, around 0.7, a little bit less on the direct perpetuals, a little bit more on the inverse perpetuals, and results also turn out to be a little better on the inverse perpetuals, even though we're taking a slightly larger size of position. And then at 5 days, of course, the hedge ratio reduces because we want to be more conservative. Over 5 days, the probability of automatic liquidation is much higher, so we naturally take a much smaller position. So our empirical study, we're going to output the hedge effectiveness, we're going to look at the liquidation probability under the optimal strategy, and also the implied leverage under the optimal strategy. So hedge effectiveness is the usual metric, the percentage reduction in portfolio variance. We can use this limiting result from the extreme value theorem for this one here, will give us this approximation for the liquidation probability. And finally, if we look at the implied leverage under the optimal strategy, starting off with the margin per contract, which is M, divided by theta star, so that would be in USDT, so the margin rate per contract is divided by F to get the rate, and then turn it upside down to get the implied leverage. That's how we calculate that. And here, rather small type, I'm afraid, you can see the empirical results. So let me just have a look. Say Deribit here, hedge effectiveness can be anything between 36% and 90% over 1 day, anything between 59% and 85% over 8 hours, and it drops right down to 17%, but it goes up to 95% at the 5 days. So what do these different figures correspond to? Well, our loss aversion here, if we've got a low loss aversion, we'll take a larger position, and so the hedge effectiveness could be greater, and it also depends on the amount of collateral we have in the margin account. If we have very little collateral in the margin account, we're much more likely to get liquidated, and so the hedge effectiveness goes down. If we follow the optimal strategy, then we find that overall, and we're doing everything on a rolling basis, but overall the probability of liquidation is very low. It's rarely more than 1%, 1 in 100, 1.5 here, 2 there, 2.1 here, 2.5, 2.6, but in the region of around 1%. If we have enough collateral, it's rare. Okay, yes. No, I don't see anything more than, here we are, on Bybit, even with a large amount of collateral. You could, if you risk, because you've got a low lambda, you could actually have a much larger liquidation probability. And then the implied leverage is sometimes up to about 6 or 8 or 3 or 4 or 7, but can also be pretty low, 1 or 2. Average figure over all of these, about 5 times leverage is all we would go for. So in conclusion, and hopefully I haven't gone too much over time. Oh, I've got 5 minutes left. That's good. We can have some questions. So the size of the optimal position decreases with the hedge horizon. It also decreases if we've got a tighter margin constraint and a greater liquidation loss aversion. So that's why we definitely need to include those features. The size depends very much on those parameters. Inverse and direct products are highly effective. You can quite often get effectiveness exceeding 90%, provided the margin level is not too low, and it's usually slightly more in inverse perpetuals. The optimal strategy will give a hedge ratio of around 0.7 for 1-day horizons, depending on these other parameters, okay, but 0.4 for 5-day horizons. But again, it really does depend on the other parameters as well. The optimal strategy is also very conservative. There's a low implied leverage, maybe less than 5%, but also a low liquidation probability. We didn't find a huge difference in hedge effectiveness, but I think we need to do a little bit more in the way of statistical tests on significance of difference between the different venues, because probably there's a lot more we can do there with those results. But clearly, if there's not much difference, then we would choose Deribit because it has the least speculative activity, and Bybit has the most. Okay, so got to the end. I hope I didn't get cut off because it's been very quiet. Ah, David, you're still there. Good.
That's